Hi, Chris Camburn here, 1406 Financial, and this video is going to talk about interest rates and why bond prices decline as rates rise and why bond prices rise as rates decline. So let's run some disclaimers and get into things. Friday, October 14th, and year to date, bond prices have really dropped, and that's because yields have risen. And they've risen because the Federal Reserve has been raising interest rates to fight off inflation. Let me give you some headlines here just to, for fact checking, I guess. So just headlines from the Wall Street Journal. Fed on track for another large interest rate hike. More Fed tightening expected. Inflation. Rate rises dim corporate bond outlook. Sticky inflation solidifies bets on another big rate rise by the Fed. The next Federal Reserve meeting is early November, and the consensus seems to be that they're going to raise rates by another 3/4 of a point. So allow me to explain why bond prices go down when rates rise and how bond prices can rise when rates decrease. And through a spreadsheet, I'm just going to get something open here and hope that I can make this as easy for you as possible. Now, a little bit of an explanation. Bonds are generally issued in denominations of $1,000 per bond. So for my example, I'm going to have an example here where you're going to buy 10 $1,000 bonds. You're investing $10,000. Coupon rate is the stated rate. It's not your total return necessarily. I'll show that in a moment. But coupon is the stated rate of the bond. This bond here, for example, is going to pay you 5% a year for as long as you own it. In this example, 5% on $10,000, that's $500 of interest. That's every year. And then when it is redeemed, you'll get your principal back plus the final year's interest. So in this example, it's a one-year bond. So $10,000 at 5% for 1 year. You invest $10,000, you get back $10,500. You have $500 worth of earnings, right? Pretty straightforward. And let's see let's just get into it. So you have this bond. Now, if the bond's longer than 1 year, in 1 year, interest rates are probably going to change. They could go up, they could go down depending upon what time period you're looking at. But let's assume that in 1 year, at the 1 year mark, you have 1 year to go on your bond. So you purchase this bond, and in the first year, you got your $500 of interest. And now for year two, you're expecting $500 of interest and your $10,500 back. But in the beginning of year two, another bond comes along that for the same amount of time and the same credit quality, which are important factors, if it's identical, all things considered, you're going to have to price your bond to match the new bond. So what that means, the bond market's looking forward, or a bond investor wants to know what they're going to get now and what they're going to get returned. It doesn't matter. Your experience, you've held this bond for a year, you made 5%. You're going to hold it for another year and make 5%. What happened in that first year doesn't matter to the new buyer. They're going to look at your bond, and they're going to look at what's available and see what's going to be the best rate of return for their holding period. So let's assume in a year, bond prices go up such that new bonds are now paying 6%, not 5%. So an investor can buy a new bond at 6%, which is $600 a year, and after 1 year, they'll be refunded. They'll be returned or redeemed $10,600. So looking at your bond, if they pay you $10,000 for your bond and earn $500, they're walking away with $10,500. But if they buy the new bond at 6%, they're walking away with $10,600. So that's why the offer on your bond, and if you want to sell it, now you don't have to, you're going to hold it, because the offer on your bond is going to be $9,900. You bought it for $10,000, but that doesn't matter to the next buyer. The next buyer is going to pay you what's going to make them the same amount of money. And so that's why your bond price is going to go down by the difference in what someone can earn. So let me go through that again. If your bond's at $10,000 for 1 year, a potential buyer is going to make $500 on your bond if it's priced at $10,000. Or that new bond over there, that shiny new bond, to be silly about it, that's paying 6% is going to return to that investor $600. So for that person to make the same amount of money off on your bond, you have to price your bond at what's called a discount. They've got to make up that $100 in earnings by paying you less. So your bond went down in price, right? So that the earnings, again, 10,000, right? The earnings have to be the same for the new buyer. So 9,900. If they buy your bond for $9,900, they'll earn $600, just as, I should format that the same, just as they would earn off the new bond. And how this gets magnified in bond prices is when there's more than 1 year. So let's assume, for example, that you buy a bond for $10,000 and it's 5%, and it's going to pay you 5% for 5 years, right? So it's going to pay you back 5% for 5 years. You're going to earn $2,500 of interest. You're going to redeem for $12,500. But again, here comes a shiny new bond. You've held your bond for a few years, and it doesn't matter for how long you have had it. It's for how much longer it's going to last. So if you have a bond that is 7 years and you've had it for 2 years, there's 5 years left. If you have a 15-year bond and you've owned it for 10 years, you got 5 years left. So I'm going to use 5 years left as the math on this. You got 5 years left, and it's going to pay you $2,500. Your bond's going to pay you $2,500 for 5 years. But now with 5 years left, for however long you've owned it, interest rates have stayed the same. Now for the next 5 years until you're done with your bond, these shiny new ones are going to pay somebody 6%. So 6% for 5 years is $3,000 of interest, right? So the earnings on a new bond are $3,000. The earnings, if your bond is priced at $10,000, the earnings are only going to be $2,500. Perhaps you can see where I'm going with this. To make your bond as attractive to buy, your old bond as attractive to buy as the new bond, somebody would offer you. Now, you don't have to sell it. You can sit around, because when they say, hey, I'm going to give you $9,500 for your bond, that way the earnings match, you may say, I'll take it. I need the money. You may say, no, I'm going to hold to maturity because I know that my bond will rise from $9,500 that you're offering me. I know my bond's worth $10,000. I'm not selling it. I'm going to wait around and get $2,500 of interest and my $10,000 back. So no, I'm not going to allow you to buy it for $9,500. I'm just going to hold it. But a new purchaser, that's what they're looking at. They're looking at how much they're going to make from the time they purchased until maturity. And to get things to parity, you have to drop the price. You have to drop the price of your bond, right? So conversely, let's look if rates go down, right? So if rates go down, so interest, it's only 1 year, so $500 of interest, and let's say 4%, so that's $400 of interest, right? All right, so here you've had your bond, and it doesn't matter how long you've had it. Let's assume you have 1 year left on your bond, and your bond is going to pay $500 of interest for this next year, and then you're going to walk away with $10,500 total when your bond matures. The shiny new bonds, maybe they're not so shiny right now. These rusty new bonds are paying 4%. So a buyer of a new bond would earn $400 of interest and walk away with $10,400. So what that means to you, they say, hey, look, I'll buy your bond for $10,000 because they know they'll walk away with $500 of total returns. And you're going to say, well, not so quick. I know that you're only going to make $400 on that new bond, so I'm going to price my bond here at $10,100. So now your earnings are at parity, right? They're still going to earn. Now, when you change the price of your bond, it doesn't change the interest rate. It doesn't change the interest rate. It changes the amount of money you're going to make, right? So if you have a bond that, as we did earlier, $10,000, it pays you $500. You bought it for $10,000, it pays you $500. You make $500, but if you pay $10,100, you pay $100 more. It's called a premium. Your earnings, you pay $10,100, it redeems for $10,500. Now you've only made $400, which matches up with the new bonds. And then to magnify this, let's say this one lasts for 5 years, so that your bond for the next 5 years, it's be back to that 5%, $2,500 of earnings. So they'll redeem the bond for $12,500. And here's this rusty new bond, if you would, to be silly. 5 years at 4% is $2,000. This bond will only be redeemed, for $12,000 instead of $12,500. I think you see where I'm going. That means you can price your bond at $12,500 to match. See the earnings. If you sell your bond at $10,000, they're going to earn more by buying your bond. So you're not going to let them do that. When I say $10,500, the price of your bond is going to increase so that the total earnings for the remainder of the time period of your bond matches what the marketplace is currently offering. So that's why as yields go up, bond prices go down. And as yields go down, bond prices go up. Very simple math. It gets a lot more complex out there. Other factors in this are credit quality, time periods don't always match up, the amount of bonds you're buying. You get better pricing the more you buy, just like any sort of store you go into. The more you buy, the better deal you get. So there's a lot of factors that go into buying bonds and assessing which bond to buy, and if you have a bond, if you should sell it to buy another one. But hopefully the basic premise here of why bond prices go down when yields go up and why bond prices go up when yields go down, hopefully I did a pretty good job of explaining that so that you can understand how things are going and why things might be happening with all the moves that the Federal Reserve's making. Well, thanks for watching. Look forward to seeing you back here real soon. Thank you.